Hello, everybody. Happy Thursday afternoon. Thank you so much for joining us. My name is Lauren Rifflin, and I head up communications here at Street Easy. Today, I'm coming from you live from my little Upper West Side corner of New York City, a rainy New York City at that. I'm incredibly happy to be here and welcoming you all virtually to this third session of our 4-part homebuyer seminar. If you missed out on any of the earlier sessions, we had 2 on Tuesday, and we also have another one later this afternoon. Do not worry, all of the sessions are being recorded, and we'll send them to anyone who registered, whether you attended or not, once we wrap up the series at the end of this week. Now, what's in store for today? For the next 45 minutes, we're focusing on everyone's favorite topic, money. If you have any questions about loan approvals, interest rates, or just want to figure out how much home you can afford, you've come to the exact right place. Before we get started, I want to highlight the Q&A panel, which you'll find just down at the bottom. That's what we'll be using for our live Q&A session after our expert does his presentation. Pop your question into the Q&A panel at any point during the program. You can also upvote. So if you see that someone else asked a question that you're really interested in, go ahead and upvote that question, and we'll get to it as quickly as we can. It'll also help me kind of monitor what are really popular questions so we can get to those sooner. Okay, let's get to the good stuff. I'd like to welcome today's expert, Tony Zhao, longtime residential loan officer at Investors Bank in New York City. Tony, if you want to turn your camera on, awesome. I'm super excited for all of you to learn from his wealth of knowledge on preparing finances for the home buying process. And that's it from me. I'll be back for Q&A. Tony, welcome, and please take it away.
Lauren, thank you so much. And thank you so much for the opportunity. Thank you everyone for, coming, and hopefully I can give and present some of the information that I've been giving to many homeowners throughout the years. First off, my name is Tony Zhao. I am a residential loan officer at Investors Bank. We're a local New York City lender. We've been doing this in New York City since 1926. So the first part of my presentation is on the pre-approval process. And, I tell clients, I tell everyone that I can that the second you start thinking about the possibility of buying a home, I think getting pre-approved is the first thing you should do. Because what the pre-approval does is it's sort of like a roadmap into your financial picture. You should approach any lender, a loan officer, a professional mortgage broker about this process. And what they do is they go into details about your affordability, your ability to support a mortgage. And I'll tell you what banks look at. So usually you kick this off, I would say 90 to 120 days before you start putting in an offer. And what banks look at is very, very simple. It is your income. So if you are a W-2 employee, what we look at are simply your pay stubs, your W-2s, because what we do is we take your ability to pay the mortgage, we look at how much you earn versus what the mortgage payment is going to be. So there's something called a debt to income ratio that banks look at. What they do is they take your average salary, and your debt to income ratio includes the mortgage payment. It includes the future carrying cost of the apartment. So if it's a condo, you have your common charges, you have your property taxes and homeowners insurance. And if it's a co-op, you have something called maintenance. And we take that into consideration to see if you can qualify and pay the mortgage down the road. Now, I would say prior to COVID, when we did somebody that were self-employed, it was a little bit easier. And what we asked for were tax returns for the last 2 years. Now, a lot of banks are asking for tax returns. And if you're self-employed, you sort of start working on something called a profit and loss statement. So the profit and loss statement is simply just your year-to-date financials and the health of your business. Because of COVID, you have a lot of businesses that are suffering, not doing well. So the bank wants to know that you do have the ability to afford the mortgage, because certainly you don't want to be late after the mortgage payment is done. Now, many years ago, there was a law that was passed, which is called Dodd-Frank. A portion of that was also called the Patriot Act. When buying a home, banks are going to vet where the funds for the down payment came from. And what they usually do is they look at 60 days of bank statements prior to the date of the contracts being executed. So anything on your bank records, they're going to look at, and any deposits that come in, they're going to want to know where the deposits came from, because we have to show the government, the Federal Reserve, where the banks get their money from, that the funds were not borrowed or the funds were not illegally obtained for the purpose of buying a home. So these are all things that you must get ready prior to purchasing a home, because this is something that all banks will do to follow federal guidelines. So the goal of the pre-approval is really to say, hey, we know what you can afford. And right now, I don't think you can see an apartment unless you have a pre-approval. So I think 120 days prior to the purchase is key. I think 3 months is safe, but certainly do get pre-approved. Next slide. So as you guys know, in New York City, most of the properties that you're going to be looking at are condos and co-ops. I think the stats are 60% plus are going to be co-ops. The rest are going to be condos. And most of my career, I focused on condos and co-ops in Brooklyn and Manhattan. And when I talk to a new buyer, what I tell them is that 70% of buying a home in New York City is about the collateral. The collateral is the building you're going to buy in. And 30% is about you as a buyer, where we take a look at your income, your credit, your assets. So people are often shocked by that, because in New York City, the condos and co-ops are like a human being, if you think about it, right? They both have financials, they have tax returns, they have a savings account, they have a budget. If anything were to happen to that co-op, it could have a financial impact on you as an owner of the building. So I'll give you an example. So let's say if you have a co-op and all of a sudden they need a boiler or a roof replaced, and all of a sudden it costs $500,000 to replace in a large cooperative. Now, as a shareholder, what could happen is you can have something called an assessment, and that's going to be passed down to each owner or shareholder of the condominium or the co-op. And that could have a trickle down effect on your financials. Imagine all you can afford every single month is a mortgage payment, common charges, or maintenance of $3,000 a month. If the building has issues with its financials, they're going to pass it on to their shareholders, and they could have an assessment on you, which could cause financial hardship. So that's going to cause you to be late on your bills, hurt your credit score, and also the mortgage. And we saw this in 2008 with a lot of projects when they went belly up. So after the Dodd-Frank bill, banks started putting a lot more emphasis on vetting the condos and co-ops prior to 2008. So I'll tell you, projects where you have one entity that owns more than 20%, usually banks are going to shy away from. So imagine you have, let's say, a sponsor or a landlord. They own 50% of the units. And think about what's happening with COVID. You have a lot of renters that are not paying rent. Well, what's going to happen is that landlord or that sponsor also has a mortgage. And if that's going to cause them not to pay their mortgage payment, a lot of the times the sponsors will file something called Chapter 11 or 13 or bankruptcy. And what the first thing they do is they stop paying their carrying charges to that building. And inversely, it's going to affect everybody else in the building. So there's something called a questionnaire when a bank does a vetting in a project. And they ask these 6 very important questions, which are how many units are sponsor owned? If there's a litigation in the building, because think about it, if there's a litigation that could cause the condo or co-op large legal bills that's going to affect everybody in the building. So on that questionnaire, we usually ask if there's a litigation. And if there is, we want to know what the litigation is about, if it's covered by insurance, so on and so forth. So these are big things that we look at when we start doing due diligence on a building. Now, you have a lot of properties in New York City that have large commercial spaces, right? Think about the pandemic. A lot of businesses are not doing well. So imagine if the building depended on this commercial property and all of a sudden they don't have the ability to pay rent. Well, the financials of the building, if 35% of the financials are dependent on that commercial property, then guess what? The building is going to suffer financially. And like I said, the bottom line always comes down to what you call an assessment. They're going to impose an assessment on all the shareholders and owners of the building, and that's going to hurt you as a shareholder. That's why these questions are so important. Now, this condo questionnaire process is done the first week when you go into contract. When you find a lender, they start doing their due diligence to make sure that they have the ability to lend to you. So you'll know if this building is lendable within the first week after you go into contract. And as you know, there's a lot of properties in New York City where there is a proprietary lease. So we've seen issues in Manhattan where proprietary leases were not renewed. And if they are not renewed, what happens is it's going to cause it could actually decimate the financials of a building, because imagine it costs $2 million to I guess, pay the lease on the building. All of a sudden, due to rising prices, the proprietary leaseholder says we want $100 million. Well, that can destroy the building's financial, which is why when we start doing our due diligence, the proprietary lease question is one of the largest and the most important question that banks emphasize. Next. So I think this is really common sense, but I kid you not that when we start doing due diligence on a buyer, it is very, very crucial that these things you keep after the commitment is issued. So paying your debt on time. From the time your mortgage is approved, there's going to be a lag from the time the commitment is issued till the time that you actually close on the property. I'll give you an example. Right now, current turn time for an approval on a condo is anywhere from 30 to 45 days because banks are backed up due to the pandemic and also where rates are. So after your commitment is issued, you still have to go through something called a board approval for a co-op, and you still have to get board approved if it's a condo. On a condo, there's something called first right of refusal by the management company. And if it's a co-op, you have the co-op that's going to approve you, which is the board. So from the time that you start the process, let's say on a co-op, it could actually take 30 to 45 days when the commitment is issued. So from the time the commitment is issued, you're submitting your board package to the management agent, and that could take another 30 to 60 days before you close on the loan. So we've seen a lot of issues, especially right now, where after the loan has been approved, somebody may miss a payment or miss paying a bill. Now, the bank and any lender in the United States will do something called a soft view of your credit report. That soft view is to check and see if you're paying your bills on time during the approval process. They want to make sure you also didn't take out new debt. So when paying your bills on time, that could have an adverse effect if you don't, because every bank is going to repull your credit, usually, I would say 5 to 10 business days prior to closing. Also, keep paying your rent. Now, I would say prior to the pandemic, banks, if you had a certain credit score, would never do something called a verification of rent. So they want to know that you're paying your rent on time because that's an indication of how you're going to be paying the mortgage. So usually what's being done is a week or two prior to closing, we will ask the buyer to get us a verification of rent, either from the landlord or the management agent. Now, if you don't have the ability to do that, what we'll do is we'll ask you to physically send in 12 months proof of rent to ensure that you have been paying rent. There's a lot of press, there's a lot of, I guess, public announcement saying that if you suffer from COVID, if you're suffering during the pandemic, you don't have to pay rent. Well, what we want to do is to ensure that if you can't pay your rent, are you going to be able to pay the mortgage? That's why banks are doing something called the verification of rent prior to closing. This is also something that is being done relatively new due to COVID. Keep working, okay? Keep your hours up. Make sure that if you're changing your jobs, let the lender know. I had a client who was laid off a week prior to closing. When we did a verification of employment, we found out that that person was laid off. And unfortunately, we weren't able to approve them for the loan even after the commitment was issued. Because if you don't have a job, how are you supposed to pay the mortgage? Part of the Dodd-Frank bill states that there's an act, it's called the Ability to Repay Act. So in order for you to get federal mortgage, federal funding, which is a mortgage, you have to show the ability to pay your mortgage. So these days, most people have ADP, they have online payroll. So just make sure that you have the capacity to show your pay stub when you're asked for by the bank or the lender. And the most important thing is ask as many questions as you can. In the beginning of the process, during the process, manage your time frame because a lot of folks still have leases that they really have to kind of manage. They need to know when they're going to close, when they have the ability to end their lease. So these are all very important questions to ask and manage expectations. Know when you're going to be able to close. Just because a lender gave you a commitment doesn't mean that you can schedule a closing for next week, especially in New York City. So please keep that in mind. Next. So these, in my opinion, are large don'ts in New York City. And I emphasize this because these are things that people do often, and it could interrupt the purchase process. So you purchased a new home. What do you want to do? You want to furnish it, of course, right? So a lot of folks go out and they start buying furniture. Well, the furniture companies want you to take out credit to buy because they make money on, I guess the lending of it. Well, a bank's going to approve you based on your income and the new debt you're about to purchase, which is why we pull credit right before closing. We want to make sure that you didn't buy a new car, that you didn't purchase anything on credit, because now we have to re-underwrite the loan because the amount of debt you had prior to the approval could have changed post approval. So we do a new credit check 5 days prior to closing, which is a soft view. And sometimes we'll come back and we'll see somebody purchased a new car. Well, that $600 a month in car payment may have thrown you over the threshold for the ability to get a new mortgage. We do a credit check. Now, on the back of your credit report, it tells us new credit checks, if there's been new credit issued. So when it comes down to new credit, it is so important that you don't do anything prior to closing because it could affect your approval. Now, moving money around, I get, right? You want to move money, you want to ensure that you have assets for closing, but the Patriot Act ensures that any money going into your bank account prior to closing has to be sourced and seasoned. What that means is any deposits, like when the bank does an approval, they're going to go through each and every line item of your bank statement during the process, before the process, but we're not going to do it after. So when we look at bank statements prior to closing, because you have to show that you have the money for a down payment, we sometimes see large infusions of cash prior to closing. And sometimes those are not things that you have the ability to prove to the lender. So it is so important that you understand, and like I said, ask questions. Before you take any money from family, friends, please let the lender know. Talk to them about the process, have them walk you through it. Because when you take in money, you always have to prove it to the bank where it came from. They want to make sure that you did not borrow the money for a down payment or purchase of a home. And they certainly want to know where the funds come from for legality reasons. And this is part of a federal law. It is not bank specific. It is with every lender in the country. Next. So I think what folks don't realize is that New York City is one of the most expensive places to buy a home. If you're buying a home, let's say in Ohio or California, you don't have a mansion tax, or not that I'm aware of. You don't have a recording tax. You don't have a mortgage transfer tax. On a condo or anything that's not a co-op, the transfer mortgage tax is 1.9% on the loan amount. Anything over 1 million, you have to pay 1% mansion tax on the sales price. If you're buying in a new condo development, right, now you have to pay the seller's transfer tax on 1.9% of the sales price. So when you're buying, let's say, a $1 million property in New York City, you should account for all the lender's title insurance, owner's title insurance, recording fees, mortgage tax, real estate taxes. I would estimate that if you're buying a condo, you should set aside anywhere from 3 to 5% just for closing cost. Co-ops are less because you actually pay something called a flip tax when you sell the unit, and that's specific to each cooperative. So co-ops closing costs should range, if it's under $1 million, anywhere from $3,000 to $6,000. And on the condo end, on a $1 million home, you should be looking at anywhere from 4 to 6% of the sales price, right? I mean, that's pretty extravagant when buying a home. So these are things that you need to account for, because aside from your down payment, the closing cost for a purchase in New York City cannot be financed. It has to be paid outside closing, meaning if the closing costs are $50,000, you have to pay the $50,000 plus your down payment, okay? So I think the common misconception about interest rates are that mortgage rates are tied to the Fed fund rate, right? Everybody will come to me and say, Tony, the Fed's rate right now is at 0%. Well, that's correct, but it has nothing to do with long-term mortgage rates. Long-term mortgage rates are tied to usually the 10-year Treasury bond, to supply and demand, and I guess it depends on how much volume the bank has, or if they need to slow things down. If you can go to the next slide, I would love to just kind of show the audience, the Fed fund rate versus the mortgage rate. So you can see the Fed fund rate is nearly at 0 or below 0. And this is done a little prior to the 0% mark. But mortgage rates has gone up, it has gone down. So the market is on a tear today, and a 30-year fixed average loan for loan amount under 510 was at 2.625 last week. Well, today it's close to 2.875. So the relationship between the Fed fund rate and mortgage rates are not tied together as one would think. So if a bank has so much volume that they can't handle the amount of business that they have, because they need to, I guess, manage expectations and not hurt, the bar, and be able to commit and send an approval, then they're going to raise rates to slow things down. So just remember, rates are going to go up. It is going to go down. It is not tied to the Fed fund rate. We are at all-time low for mortgages right now. So in my opinion, that's why you're seeing such a huge demand for purchases and refinances, which is why I wanted to really touch on the fact that mortgage rates are not tied to the Fed fund rate. It's so important for folks to know that, because at some point when this is over, you're going to see rates go up sometime in the next quarter or so. Thank you.
All righty. Thank you so much, Tony. I don't know about everybody listening, but I certainly feel much more informed. And I mean, there's a lot to think about here, but there's certainly ways to organize and prepare yourself. The latter seeming like the most important thing to do. Do your research, prepare, get organized. So thank you for letting us all learn, tap into your brain for a little bit. We do have quite a few questions in Q&A, so I'm excited to jump in, and reminders, everyone. So Q&A is at the bottom, and upvote questions, and I'll get Tony and I will get to as many questions as we can. And also quick plug, of course, for the blog, where we'll continue to provide resources, and maybe even some of the questions that you ask will end up being blog posts in the future. So let's get into it. The first one at the top, let's revisit what debt to income ratios. So what debt to income ratio is considered good?
Great question. So if you're buying a co-op in New York City, and I was a treasurer of my own co-op for many years, the debt to income ratio in New York, especially Manhattan, cannot exceed 28%. So I'll give you an example how you calculate that. So if your income is $10,000 a month gross, not after deductions, gross, you cannot exceed 2,800 of that 10,000. And what that 2,800 includes, the mortgage payment, the maintenance, and everything that's on your credit report. And that includes your student loans, credit cards on a monthly basis. Now, if you're buying into a condo or a single family home, usually a bank will allow you to go up to 50%. But with New York City being so co-op centric, most of the applicants that we see that are applying in co-ops usually cannot exceed 28%, which is why you have so many what you call co-signers, parents jumping on the mortgage themselves so they can bring the debt to income ratio down. So 28% for a co-op, but on the bank end, they usually will have the ability to go to 50% debt to income ratio.
Okay, got it. And is there, is there an easy tool or anything that you have where people can use to help calculate all this, or?
Yeah, I have
video.
aside from that, well, I have rent versus buy calculators. I have calculators. Okay. You have mortgage calculators that you can just look up online. But I think that using the rhythm of gross and what the 28% debt ratio on the $10,000 gross income, that should give you a good indication of what your debt to income ratio should be. But of course, feel free to reach out to me. We have Excel calculators that we can hand out for free to audiences, and they can plug in what their gross is, what the mortgage payment is, and what the maintenance is, and it's actually going to give you a pretty good calculation. But again, there's tons of things online, and also I think StreetEasy has a few things that can help. So definitely just look it up.
Awesome. Assistance with down payments. So next question, if I need assistance from my parents for the down payment, what's the best way to do that?
Totally. So getting a gift for purchasing a home is something that a lot of folks do, especially in New York City. So you would need to fill out something called a gift letter for the bank. They would tell you or give you kind of instructions on how to get the assets, the down payment from a family member. And remember, this is key. When getting a gift for home purchase, it has to be a blood relative. It cannot be a friend, it cannot be a coworker, you cannot borrow the money. The gift letter is common, and every bank has their own specific gift letter. And that gift letter will state that the funds being received for purchasing a home is not something you need to pay back, because you cannot borrow money for a down payment. It has to be gifted. So totally fine. You need to talk to a loan officer. The loan officer is going to walk you through the process of getting the gift and filling out the information for that gift letter. But again, very, very common in New York City. I myself use that the first time I purchased my co-op, and everybody does do it.
Got it. Okay. So it's a gift, blood relative, work with your loan officer.
Totally.
I may, in true New York fashion, I have construction going on right outside. So I'm going to mute and unmute strategically. So the next one, and I like this one, I'm gonna actually add a second question to it. So how do you secure the lowest interest rate possible? But I'm gonna add, what are the best ways to track interest rate movements?
So I think this is a relatively hard question, because, think about how many banks there are in the United States. So you have a lot of folks that will go online and they'll just look up mortgage rates. And you have some banks that are not located in New York City offering great rates. Yes, I do agree that interest rate is extremely important when it comes down to buying a home. But I've seen many instances where somebody purchases or goes with a bank that doesn't understand the nuances of New York City. And 45 days into the process, the bank says, we can't lend in the co-op. So in my opinion, a rate means nothing unless the bank can close. So my advice is, just make sure that the lender you're working with, that you've committed to, understands the co-op condo process. Not to mention, every bank that lends in New York City has a lender's list of buildings they have approved or declined. So that is very, very important. Like I said, I tell my buyers 70% of getting a mortgage is about the building. It is not about you. So as long as the bank has lent in the building and understands the co-op and condo, that is probably, in my opinion, key, instead of chasing the rate.
Great. And a bit of a, I'm going to skip to one that's related. So at what point of the process is a good time for the buyer to ask about these details about a condo or a co-op building?
So I think the real estate agents that you as a buyer are going to work with will usually tell you, because when a bank does a pre-approval, they don't approve you based on the building. They don't approve you based on the condo or co-op. They're approving you based on your income and what the mortgage payment is. And I, as a New Yorker, usually estimate, look, if you're buying I keep on saying million because it's easy to round up. So if you're buying $1 million condo, you should expect common charges and taxes of $1,500 to $2,000. So I work that number into the calculation. If you're buying a $500,000 co-op, I calculate, $1,200 a month for maintenance. And as we all know, each condo and each co-op has different financials. Some could have very high carrying costs, some could have very low carrying costs based on the financials of that building. So I think it's really a relevant question that you should ask your real estate agent, because your real estate agent knows what you're probably going to be able to get and approved for. So I think that magic number of 20% for debt to income ratio is key, because if you have somebody that can't put down 20%, most likely you will not be buying into a co-op, because most co-ops require that 20% threshold when buying into their unit.
Wonderful. Next question, if your income is heavily dependent on an annual bonus versus a salary, how does that impact things?
Very good question. You know, we are in New York City, which is the financial capital of many financial institutions. We work with a ton of folks in finance where they have a certain salary, but their income is based on bonus and commission. So if you work on Wall Street, you're a finance person, you're getting your yearly bonus Q1 of each year. So banks will use commission and bonus, but you have to have that income for 2 years. So we're going to look at the continuity of that income. We're going to average the 2 years of the bonus and commission to come up with the algorithm for the debt to income ratio. I can tell you that the federal guidelines for lending is that if you don't have 2 years of bonus, or I would say commission from the same financial institution that you work in, then you may not count that income. So we do see that with folks going from place to place. So imagine if you worked at Bank ABC for 1.5 years. And if you haven't received 2 consecutive bonuses from Bank ABC, you will not be able to use that income, and you can only use the salary.
Got it. Okay. And so another income circumstances question, since we're on the topic. So if your income recently increased significantly due to equity-based compensation, does that have an impact?
Yes, absolutely. So when we do a pre-approval, we asked if you're a W-2 employee. We asked for your 2019 and 2018 W-2, but we also ask for your pay stub, the last 2 or 3, because the pay stub is going to give the lender a good indication of what your current salary or your income is, because the 1099 or the W-2 could be off compared to your current pay stub. So we actually look at your current pay stub, which actually will usually break down every part of how much you're earning, if it's equity based or if it's cash bonus incentive. So the pay stub really will detail how we calculate that income.
Great. The concept of buying points. Can you help explain the concept of buying points to lower the interest rate of a mortgage?
Absolutely. So I'll give you an example. Let's say your rate based on your income, based on your credit score, and based on the loan amount is, let's say, 2.5% on a 30-year fixed. You have the ability to buy the rate down, which is what they're referring to. So typically, at least with most lenders, for every 1% on the loan amount, you can buy the rate down 1/8 of a point. So you take out a $500,000 loan, you want to buy it down 1/8 of a point, and that means at closing, you're going to pay 1% on the loan amount. So on a $500,000 loan, you're going to pay the lender $5,000 to bring the rate down that 0.125%. I do get asked that question, and I do say, look, I think you should do your due diligence, right? You're paying $5,000 to bring the rate down 1/8 of a point. Now, most mortgages are amortized, right, spread out over a 30-year time frame. So if you're dropping the rate 1/8 of a point, how much is that going to affect your monthly mortgage payment? Is it $20, $30 a month? Because if it's $20, $30 a month, how long is it going to take for you to recoup the $5,000 that you're spending to buy that rate down 1/8 of a point? And most New Yorkers, or actually most Americans, don't stay into one mortgage for more than 10 years. So by the time you recoup that 1/8 of a point, that $5,000 that you spent, would it be 7 years that it's going to take to recoup it? So it may not be worth it. I don't think that's something that I see often, especially if you do your due diligence and calculate the monthly difference between 1/8 of a point and the $5,000 or 1% that you're spending on to bring that rate down.
Great. I mean, if anything, you are proving that it is incredibly important to have some honest conversations with a helpful loan officer. This is all fantastic. And also, I mean, for the audience, you can see that like there are such personal and individual circumstances. Buying a home, buying an apartment is incredibly personal and customized and individual. So it's important to have a loan officer, personal finance advisor on your side who can help think through your individual scenario. We're almost at time. I might hold you, Tony, for like 3 minutes over. We have some awesome questions coming in.
Good.
So everybody who's on, if you want to hold on with me for just a couple minutes past 2:45, I welcome you to do so. These are some great questions. Thanks so much for engaging and submitting these. At the most upvoted right now is returning to the Patriot Act. So are the Patriot Act issues applicable if you're just moving money from one bank account you own to an account you own in a, jump to the bottom, you own in a new bank? So if so, how early does the transfer need to happen?
So the Patriot Act was enacted to ensure that folks from overseas weren't funneling money into the US by laundering it, right? Because when you purchase a home in cash and you sell it, the proceeds are now considered, in my opinion, what you call, I guess, sourced, right? So they want to make sure that you didn't borrow the money or the money did not come from illicit gains. So with that being said, you can move money around 100 times within 60 days, as much as you like, but as long as you have the ability to document that. So in that specific scenario, you would show the bank statement from the old bank going into the new bank, and that would be sufficient enough. Now, that's not something you really want to do, because do you really want to show and create more work for yourself? Because every month that goes by, you're having the ability, or you're having to have, you're sending constant new statements. And sometimes we've had issues where, let's say you're closing in the middle of October and October statement's not available. You have all these deposits going in the last week prior to closing, and you don't have the ability to show that month's bank statement. So you're actually having to go to the branch, print out something online, and that creates a delay in the financing. So in my opinion, just remember, banks look at 60 days of bank statements from the date the contracts are signed. Any deposits you must source in season. And this is something that we do in the beginning of the process to ensure that there's no issues. And I can't tell you how many times that a client can get declined if they cannot source where the funds are coming from, because it is a big deal.
Got it. Okay. Great. 60 days, magic number. So I like this one just because this home type is very prevalent in New York City. New construction. So how do you vet new construction condos?
So, new construction condos usually have what you called a preferred lenders list, right? And here's something that nobody knows about. Most banks require the building to be 50% in contract or sold before you can close on a home. So you go into the contract, and the bank that is lending to you sometimes will say, you know what, here is an approval, but we're not going to close until 50% of the units are in contract. And what banks are afraid of is, on a new construction, it's an iffy process. You don't know if you're going to sell all of the units. What if the construction lender starts asking for more money or can't pay the mortgage? So banks usually have that rule of thumb where 50% of the condo must be sold before they can close. And to that question, we usually ask for something called a condo questionnaire the first week that we get the contract to ensure that there's no issue, my bank will actually allow the building to be 25% in contract before we close, but the rule of thumb at most banks are 50%.
Great. Okay. I think I'm just gonna do two more, and then I'll release you, Tony, and release everyone else. Is there a downside to getting more than one bank to pre-approve you to shop rates?
You could certainly do whatever it is that you please, but remember, every time you get pre-approved, the bank's going to need to pull your credit. And do you really want to have 10 credit pulls? Not to mention, you cannot lock in a rate until you're in contract. Remember, the bank's locking in the rate once you have an accepted offer. They lock the loan based on the sales price, the final loan amount, your social security number, and the property address, because the banks are requesting that money from the Fed or their own depositors. So unfortunately, you're subject to market volatility until you actually go into contract, at which point you must commit to a lender. You can't just pick a bunch of lenders, because now you're paying for the appraisal, the condo questionnaire. So you must choose a lender at that point. But in the beginning, you can shop around. But like I said, rates are not really relevant until you have an accepted offer.
Great. Okay. And of course, we're going to end on our crystal ball question. So when you say mortgage rates will go down, how much do you expect?
Well, in close to 20 years of being a loan officer, I've never seen rates where they are currently. And here's my advice that I would give to my own family member. Prior to the pandemic, rates were at 3.75 to 4%. Right now, you have rates from 2.625 to 3% on a jumbo loan. So most folks are really jumping at the opportunity because, look, prices may go up on a home, prices may go down on a home. You're not living with the sales price once you buy a home. You're living with the mortgage rate, and you're living with the mortgage payment. And at some point when things turn around, rates are gonna go back up. So in my opinion, I don't know how much further rates can go down. So I think there's nothing but downside, because I just don't think rates, a bank doesn't make money when they give out rate at 2.625 or 2.75. They're doing it to accommodate folks, and they're doing it to try to help stimulate the economy. So in my opinion, what's happening is not organic, it is artificial. And at some point it is going to end. And when things stabilize, your mortgage rate is going to go up from where it is right now to close to 3.75 to 4%. And one thing I always say is, would you rather lock in a rate and rates go down, or would you not lock in a rate and rates go up? And most folks will say, I'd rather lock in a rate and see the rates go down.
Beautiful. Wonderful. Well, unfortunately, that is all the time that we have this afternoon. I hope everyone enjoyed today's session and found it useful, and is leaving a little bit more informed. Thanks to Tony, I certainly am.
Thank you.
We do have another session today, the last one in our home buyer series. You'll get the inside scoop from a New York City real estate attorney on how to close. So this final, often underestimated step of the home buying journey. In the meantime, if you're looking for more data, advice, guides, research, visit our blog. Tony's contact information is on this slide. Of course, feel free to reach out to him. Thank you again so much. And thank you everybody who's on the line for tuning in today. Best of luck on your home shopping journey. Enjoy the rest of the week. Thanks.